We will now look at how to compute income under the head PGBP. First, we look at the master chart for computation of income under the head PGBP. And we look at the adjustments to be made when in the question we are given the profit and loss account and certain other information is given. So we begin with the net profit as per P&L account, and then we make adjustments to the incomes. What kind of adjustments? We add the income which is taxable but which has not been credited to P&L account. We reduce the income which is credited to P&L account but which is not taxable. Maybe because it is exempt, say under section 10, or maybe because it is though taxable but it is taxable not under the head PGBP but under other heads of income. We add deemed profits which are covered under section 41. Next, we make adjustments on account of expenses. So we add expenses which are debited to P&L account but which are disallowed, say under sections 40, 40A, 43B. And we reduce expenses which are allowed as deduction but which have not been debited to P&L account. And the various allowances and deductions are covered under sections 30 to 37. And the result is the income taxable under the head PGBP. Section 28 lists down the incomes which are taxable under this head. And in this table, we will look at certain key incomes. Profits and gains of any business or profession which is carried on by the SSE at any time during the previous year is basically taxable under the head PGBP section 28I. Section 28(2)I covers a case of compensation. Two types. One, compensation which has been received for either the termination or the modification of terms and conditions of what? Either of an agency or of a business contract or in relation to office of management of a company. That is taxable as PGBP. Second, there may be a statutory vesting of management of any property or business in the government and the government will pay compensation. That compensation also is taxable under PGBP. Third, section 28IV, benefit or perquisite. Value of any benefit or perquisite, if it arises from the business or the exercise of a profession, is taxable under the head PGBP. Section 28VA, non-compete fees. What is this? Any sum which is received or receivable under an agreement for what? Either for not carrying out any activity in relation to any business or profession, or for not sharing any intellectual property. For example, know-how, patent, copyright, etc. That is called non-compete fees, taxable as PGBP. Then we have section 28VI, keyman insurance policy. So any sum which is received under a keyman insurance policy, if it is connected to the business, it is taxable under the head PGBP, including the amount of bonus. As far as deductions are concerned, it's useful to note down certain general principles. Business expenditure is allowed as a deduction. This is what all of us know. And these deductions are and allowances are provided under sections 30 to 37. So these are allowed as deductions unless disallowed. What about loss? Loss per se is not an expenditure, but it is also deductible if it is revenue in nature. That is, it is not capital in nature. It is incurred in carrying on business or profession and it is incidental thereto. It is also deductible unless it is specifically disallowed. What about exempt incomes? We have already noted under the topic of exempt incomes that expenditure, if it has been incurred in relation to exempt income, it is not allowed as a deduction by virtue of section 14A. What about distinction between a capital expenditure and a revenue expenditure? So we need to note that capital expenditure is not allowed as a deduction under three provisions: section 30, 31 and 37(1). 37(1) is the general deduction provision and 30(31) is what we will now look at. Capital expenditure is not allowed as a deduction under these provisions. So we now move to the first theme, which is deductions in respect of assets. And we look at sections 30 and 31. And these allow for deduction in respect of the premises, section 30, or machinery, plant or furniture, section 31. And the deduction depends on whether the SSE is the owner or the tenant. 5 items are listed. Number 1, Land revenue, local rates or municipal taxes are allowed as deduction in respect of the premises, whether the assessee is the owner or the tenant, and this is subject to compliance with section 43B. Second, insurance premium is allowed as deduction in all the cases. Rent is allowed as deduction to the tenant. Fourth, repairs which are revenue in nature, these are allowed as deduction in all the cases. Fifth, repairs which are capital in nature are not allowed as deduction. However, depreciation can be claimed in terms of section 32. We now look at the provisions regarding depreciation which are contained in section 32. First, we look at the conditions to claim depreciation. There are three conditions basically. The asset should be one, a specified asset. What is a specified asset? If it is a tangible asset, the asset should be buildings or machinery or plant or furniture. If it is an intangible asset, then the asset should be know-how or patents or copyrights or trademarks or licenses or franchisees or any other business or commercial rights of similar nature, not being goodwill of a business or profession. So depreciation is not allowed on goodwill of a business or profession. The second condition is that the asset should be owned by the assessee, either wholly or partly. And the third condition is that the asset should be used for the purposes of business or profession. We now pick up or take up certain points in respect of each of these conditions. Condition 1 is that the asset should be a specified asset. In respect of land, depreciation is not allowed. What is the scope of the term building? Building includes roads, bridges, culverts, wells and tube wells. What about plant? Plant specifically includes certain things and specifically excludes certain things. Plant includes ships, vehicles, books, scientific apparatus and surgical equipment used for the purposes of business or profession. But plant does not include tea bushes or livestock or buildings or furniture and fittings. Buildings or furniture and fittings are a separate category of specified asset for purpose of depreciation. Condition 2. The asset should be owned, whether wholly or partly, by the assessee. So this means that the co-owner can also claim depreciation and to the extent of his share. What about a case of lease? Depreciation is allowed to the lessor, not the lessee, to the lessor, whether the lease is an operating lease or financing lease. What about hire purchase? Hire purchase, in that transaction there are two components. One is the sale price. Sale price as on the date of agreement, that is called as the cash value, and the other is the hire charges which are supposed to be paid, right? So deduction is allowed to whom? To the lessee, that means to the buyer, to the lessee on the cash value. Depreciation is allowed. What about hire charges? Hire charges are deductible over the term of the agreement. Now the condition is that the asset should be owned by the assessee. So what about a tenant? What about a person who is a lessee? So if the assessee does not own the building, we are talking about a building, the assessee does not own the building, but he incurs capital expenditure for the purpose of business or profession, right? And that may be in the form of construction of any structure or any work by way of renovation, extension or improvement to the building. Then such a structure or work, even though that is not owned actually by the assessee, it is deemed to be a building owned by the assessee, and consequently depreciation is allowable even if the assessee is not the owner of the building. Condition number 3 is that the asset should be used for the purposes of business or profession, right? And what is relevant is that the asset must be put to use for the purposes of business or profession at any time during the previous year, even if that be for a day. What is put to use? Put to use not only includes active use but also the passive use. Passive use means that the asset is ready for use though it is not actually used. So both active and passive use are considered as put to use, and therefore depreciation is allowed. Now depreciation is not optional, it is mandatory. Whether or not the assessee claims depreciation is not relevant. There are two methods to compute depreciation, the SLM method and the WDV method. The straight line method or the SLM method is applicable to an undertaking engaged in generation and distribution of power. In that case, SLM method applies and depreciation is calculated as per the formula actual cost of asset multiplied by the percentage rate of depreciation. So depreciation is allowed year on SLM basis and the total depreciation cannot exceed the actual cost of the asset. The undertaking also has an option to opt for the WDV method instead of SLM method. But this option can be exercised in the first previous year, that is the previous year in which it begins to generate the power. And it can be exercised before the due date of filing return of income for that previous year. If this option is not exercised, then SLM method continues to apply. In all other cases, written down value method of depreciation applies. And depreciation is calculated as WDV of the block of assets multiplied by the percentage rate of depreciation. Now the question is, what is the meaning of block of assets? Block of assets means a group of assets falling within a class of assets in respect of which the same percentage of depreciation is prescribed. There are 4 classes of assets: buildings, furniture and fittings, plant and machinery, and intangible assets. And the block means a group of assets which falls within a class in respect of which the same percentage of depreciation is prescribed. So as you can see, the following blocks arises which are relevant to us. Where the class is a building, then residential buildings are entitled to the lowest rate of 5%. This is except hotels and boarding houses. Non-residential buildings, a higher rate of 10%. Purely temporary erections such as wooden structures, the highest rate of 40%. Furniture and fittings, only one single rate of 10% applies. And furniture and fittings include electrical fittings as well. And electrical fittings in turn include what? They include electrical wirings, switches, sockets, and other fittings and fans, etc. What about plant and machinery? 4 blocks are relevant to us. The highest rate of 40% applies to aircraft, pollution control equipment, life-saving medical equipment, containers, energy-saving devices, then renewable energy devices. The important items are computers, including computer software, and books. These are also entitled to 40% rate. The next lower rate of 30% applies to bus, lorry or taxi which is used in the business of running on hire. So in the hiring business, or molds or semiconductors. The next lower rate of 20% applies to ships. And finally, the lowest rate of 15% applies to oil wells, motor car which is not used in the business of running on hire. That means general cases of motor cars. And this is also the general rate. It applies to any other plant and machinery. 15% is the general rate. Intangible assets, only one rate is prescribed, 25%. So this is the only block for this class. Now computers, as we saw, is entitled to 40% rate. What does computer include? Computer also includes the peripherals, like what? Like printer, scanner, anti-server, UPS, router, etc., which form an integral part of the computer. Now depreciation can be either normal depreciation or it can be additional depreciation, which we will look at in some time. How do we compute normal depreciation? These are the steps. Step 1. We determine the opening WDV of the block of assets, and mind you, normal depreciation is computed for each block of assets. So each block of assets is considered separately. So step 1 is opening WDV of the block as on 1st April of the previous year. To this we add the actual cost of assets acquired during the previous year. And we deduct monies payable for assets disposed of during the previous year. For example, sold or discarded or demolished or destroyed during the previous year. So monies payable is what? The price for which the asset is sold, or insurance, or salvage money, or compensation monies, or scrap values, if any. And then the result is what? The result is WDV of the block as on 31st March of the previous year for the purpose of computing depreciation. Then in step 5, we deduct the amount of depreciation. And how do we compute depreciation? It is WDV of the block as on 31st March of the previous year as per this step multiplied by the percentage rate of depreciation. This is what we deduct, and then we arrive at the closing WDV of the block for the relevant previous year. This in turn becomes the opening WDV of the block for the next or the subsequent previous year. Now, WDV cannot become negative on account of deduction for monies payable. On account of this deduction, the WDV cannot become negative. At the most, WDV will become nil or zero, in which case depreciation won't be allowed. Now, what is the quantum of depreciation? The quantum of depreciation which we deduct as per step 5. What is the quantum? It depends on the period the asset is put to use during the previous year. So where the asset is acquired during the previous year, and there are 3 situations that are possible. The asset is acquired during the previous year and it is not put to use for business or profession in that previous year in which it is acquired. Then no depreciation is allowed. Right? If it is put to use for 180 days or more in that previous year, full depreciation is allowed at the full rate. However, if it is put to use for business or profession for less than 180 days in that previous year, then depreciation is restricted to 50%. Note that 50% restriction is applicable only in the year of acquisition of the asset and not to the subsequent years. For your reference, you can note down the date of 3rd October for a normal year and 4th October for a leap year, latest by which the asset should be put to use in order to meet the condition of 180 days or more. So if the asset, say for a normal year, is put to use after 3rd of October, then the put to use will be for less than 180 days. So 3rd October and 4th October is the date that you can remember for reference purpose. Now, as we noted above, the actual cost of assets acquired during the previous year is supposed to be added. Now, how do we compute actual cost? There are 3 basic steps, 1, 2 and 3. So in step 1, we determine the actual cost of the asset to the assessee, which will be either the purchase cost or the construction cost, etc. Then to this we add certain items if they are not forming part of actual cost. If they already form part of actual cost, no further adjustment is required. What are these items? First, on account of interest. Interest in connection with acquisition of the asset. And the interest we need to bifurcate. There is a cutoff. The cutoff is the date when the asset is first put to use. So interest till this date is supposed to be added to the actual cost. It forms part of the actual cost. Interest after this date doesn't form part of actual cost, but rather it is deductible as expenditure under section 36(1)(3)(I). Second, the expenses that the assessee incurs to acquire and bring the asset to the site. For example, freight, insurance, carriage, loading, unloading, etc. These are added. Expenses to install the asset. For example, installation charges, technician fees, etc. Fourth, expenses to facilitate its use or if certain modification is necessary to make it fit to use. Those expenses, they form part of actual cost. But these are expenses which are incurred before the asset is put to use. After the asset is put to use, they can be claimed as expenditure under section 37(1). In step 3, we reduce the following. That means they don't form part of actual cost. So if they are not forming part of actual cost in the first place, no further adjustment is required. The first item, GST on which ITC has been allowed, and this also includes excise customs duty on which the tax credit has been allowed. Second, if the assessee has received any subsidy, grant or reimbursement from the government or any statutory authority or any other person, and this amount has been received for being used to meet the cost of the asset, it should not form part of the actual cost. Third, if there is a payment which is made to a person in a day for acquiring the asset, and the payment is made otherwise than by a specified mode, and the payment exceeds rupees 10,000, or if multiple payments are made to a person in a day, then the aggregate of the payments exceed rupees 10,000, then that payment or the aggregate of payment is not supposed to be included in the actual cost. What are the specified modes? Account pay, check or draft, bank ECS, credit or debit card, net banking, IMPS, UPI, RTGS, NEFT, Bheem, Aadhaar Pay. For example, payment made by cash or by bearer check or by uncrossed checks. So these are the examples, and then after steps 1, 2 and 3, we arrive at what is the actual cost for the asset. Now we come to the computation of additional depreciation, and the relevant section is section 32(1)(2)(ia). Additional depreciation is in addition to the normal depreciation, and it is computed at 20% of the actual cost of new plant and machinery. And there are two conditions to be satisfied. One, the plant and machinery should be acquired and installed after 31st March 2005. Second, the assessee should be engaged in the business of A, either manufacture or production of any article or thing, or B, generation, transmission or distribution of power. There is a negative list. Additional depreciation is not allowed on what? 5 items. Ships and aircraft, second-hand plant and machinery, plant and machinery installed in any office premises, for example, computer installed in office, or any residential accommodation, which includes a guest house. Fourth, office appliances or road transport vehicles, for example, motor cars. Fifth, plant and machinery whose 100% actual cost is allowed as a deduction, for example, capital expenditure on scientific research, which is allowed 100% under section 35. What about the case where asset which is acquired is put to use for less than 180 days in the previous year of acquisition? Similar to normal depreciation, 50% restriction applies. So additional depreciation in the year of acquisition is 50%. That means to the extent of 10%. What about the balance? Balance 10% additional depreciation is allowed in the next year. Additional depreciation is not available to a power undertaking which follows SLM method. It is available though to a power undertaking which has opted for the WDV method. Now section 43A is a section which makes a special provision in respect of change in foreign exchange rate, foreign currency exchange rate. The situation covers 3 ingredients. 1. The assessee has acquired any asset in the previous year, but not from India, from a foreign country for business or profession. So the purchase is made abroad. Second, the asset is acquired through monies borrowed in foreign currency. So money has been borrowed in foreign currency and then the asset has been acquired, or through foreign suppliers' credit. So the money is to be paid at a later point of time. Third, there is a change in the rate of exchange during any previous year after acquisition of asset, and consequently there is increase or reduction in liability at the time of making payment as compared to the liability at the time of acquisition of asset. So 2 points of time. One, at the time of acquisition of asset, at the time of acquisition of asset, and the second point, which is the later point, is the time of making the payment, and the rate of exchange in both the dates may not necessarily be the same. So there will be a variation, and therefore there will be a consequent increase or reduction in the liability at the time of making payment. Such increase or decrease in liability is adjusted. That means it is added to or deducted from the actual cost of asset, and consequently depreciation is then provided on the revised actual cost to align it to this particular change in the foreign currency exchange rate. So this is the adjustment under section 43A. Now actual cost is computed in a certain fashion in certain special cases, and we will look at 2 cases here. One, so there are several cases, we will just look at 2 cases which are important from an exam point of view. One is where the asset is acquired by the assessee by way of gift or inheritance. Gift or inheritance. In such case, what should be the actual cost to the assessee? We pick up the actual cost to the previous owner, and then we allow deduction of notional depreciation, which is what? Deduction which would have been allowable to the assessee as if the asset was the only asset in the relevant block of assets. That becomes the actual cost to the assessee. Second is a case of a private building. This particular case applies in the case of a building which is the private building, not used for business or profession, but now it is brought into use for business or profession. So when it is so brought into use, its actual cost is what? It is actual cost of building minus notional depreciation. And what is that? Depreciation which would have been allowable had the building been used for business or profession since its acquisition. There is a special provision for computing WDV in case of composite agricultural income. So where there is a processing beyond compulsory processing, composite agricultural income arises, which is to be split into taxable business income component and exempt agricultural income component. And therefore depreciation will also be allowed proportionate to the taxable business income component. But how do we compute WDV of the assets? So for computing WDV of the assets acquired before the previous year, that means for computing the closing WDV of the asset for a particular year, which will then become the opening WDV of the asset for the subsequent previous year, the total amount of depreciation is to be computed as if the entire income was business income, and the total amount of depreciation is then deemed to be actually allowed, because we deduct the depreciation which is actually allowed from the closing WDV in order to arrive at the closing WDV of the relevant previous year. So in this particular case, even when the entire depreciation is not actually allowed, because only a part is taxable business income, but for computing written down value, the entire depreciation is supposed to be deducted by virtue of this particular provision, and then WDV is accordingly computed. The next deduction for assets is an investment linked tax incentive for specified businesses, and this is section 35AD. What is the extent of deduction? 100% of the expenditure is allowed as deduction under 35AD. If it is capital in nature and it is incurred for any specified business which is carried on by the SSE during the previous year. What about pre-commencement expenditure? That is also allowed. Expenditure incurred prior to the commencement of operations of a specified business is also allowed as deduction. When is that allowed? In the previous year in which operations are commenced. But the condition is that the amount should be capitalized in the books of account when? On the date of commencement of operations. So pre-commencement expenditure is also allowed, while the current year expenditure is anyways allowed under 35AD if these conditions are satisfied. There is a list of specified businesses, but some of the select businesses are given here. Cold chain facility, warehousing facility for storage of either agricultural produce or sugar. If it is a case of hotel, it should be at least 2-star. If it is hospital, it should have at least 100 beds. Fertilizer production in India, beekeeping and production of honey and beeswax, and the business of new infrastructure facility. These are some of the specified businesses covered. 3 basic conditions need to be satisfied by the specified business for claim of deduction under 35AD. 1. The specified business should be carried on by the SSE during the previous year in which expenditure is incurred. 2. It should not be set up by splitting up or reconstruction of an already existing business. 3. It should not be formed by transfer of second-hand plant and machinery. Plant and machinery should be brand new. But there is an exception which is allowed up to the total value of second-hand plant and machinery up to 20%. So up to 20% of total value of plant and machinery which has been used can be second-hand. There is another exception in respect of second-hand imported plant and machinery. It is also not regarded as second-hand if certain conditions are fulfilled. There is a negative list, and therefore 35AD deduction is not allowed in respect of this expenditure. 1. Expenditure in respect of which a payment is made to a person in a day which is otherwise done by a specified mode and which exceeds rupees 10,000. If there are multiple payments, then we need to check the aggregate. So this is similar to the point that we saw while computing the actual cost of an asset. Second, expenditure on land 1, goodwill 2, financial instrument 3 is not allowed 35AD deduction. Implications of deduction in respect of specified business and in respect of expenditure. In respect of specified business, if deduction is allowed under 35AD for a specified business, deduction cannot be allowed under section 10AA or chapter VIAC. 10AA is the deduction on account of newly established units in special economic zone. Chapter VIAC, deduction on a by virtue of sections 80HS to 80 RRB. So either you can claim deduction under 35 AD or under 10 AA plus chapter VIAC. Deduction cannot be claimed for both 35 AD and 10 AA plus VIAC. In respect of expenditure, if deduction is allowed under 35 AD for an expenditure, the deduction in respect of that expenditure is not allowable elsewhere. Therefore, depreciation is not allowed where 35 AD is allowed, whether normal depreciation or additional depreciation. 35 AD is optional, it is not compulsory. If the SSE opts for 35 AD, then these implications arise. There is a lock-in period of 8 years which is prescribed, which means that the asset for which the deduction has been allowed under 35 AD should be used only for a specified business, right? It can be another specified business, but it should not be a non-specified business. And this restriction runs for a period of 8 years. From when? From the previous year of acquisition or construction of the asset. What if there is a default? If there is a default, deemed business income, it arises in the previous year of default. That means in the year in which the use is for a non-specified business within the 8-year lock-in period. And in such case, the amount of deemed business income that is taxable is the total deduction under section 35 AD which has been allowed for the asset. That means 35 AD deduction which was allowed is now completely reversed. However, the depreciation under section 32 is allowed in place of 35 AD. So depreciation which would have been allowable all throughout this particular period is now allowed. So while 35 AD is completely reversed, depreciation throughout this period is now allowed as a deduction. So this is the provision for 35 AD. Insurance premium which is paid for stocks or stores, it is not covered under 30 and 31, the sections that we discussed some time back, but it is covered under 36(1)(I), and this is also deductible. There are specific provisions made for amortization of certain category of expenses. Section 35D deals with preliminary expenses. Who is the eligible assessee? In the case of a company, it should be an Indian company. Where the assessee is not a company, the assessee should be a resident in India. What is the coverage of specified expenditure? A specified expenditure should be incurred either before the commencement of business. It can also be incurred after the commencement of business, but it should either be in connection with the extension of an undertaking or setting up of a new unit. The deduction is allowed of specified expenditure in 5 equal annual installments. That means 1/5 in each year. And it begins with the previous year in which either the business commences or extension is completed or new unit commences production or operation. So the question is, what is covered as a specified expenditure? So there are 7 items which are covered as a specified expenditure. While items 1, 2, 3 and 4 can be incurred by any eligible assessee, but 5, 6, 7 are applicable only to a company assessee. Who should carry out the work? In respect of all the items 1 to 7, the assessee himself can carry out the work, or the work can be outsourced also to a concern. But in respect of items 1, 2 and 3, the concern should be approved. If the concern is not approved, item 1, 2, 3 is not allowed as specified expenditure. Now we will look at these items quickly. 1, 2, 3, what are these? Expenditure in connection with what? Preparation of feasibility report, project report, market survey or other survey or engineering services. Number 4 is what? Legal charges for drafting agreements for the purpose relating to setting up of or conduct of business. 5, 6, 7 are what? This is applicable to a company. Legal charges for drafting memorandum or articles of association, fees for registering the company under Companies Act, and in connection with public issue of shares or debentures. There is a cap in terms of specified expenditure. It is not without a limit. There is a cap in respect of the total expenditure, which can be categorized as specified expenditure. So total expenditure cannot exceed the following. Where the SSE is an Indian company, the limit is what? The limit is 5% of A or B, either cost of the project or capital employed in the business of the company, and both these terms have been specifically defined. If the SSE is not an Indian company, then what is relevant is only 5% of cost of project. Capital employed is not relevant to a non-company SSE. So specified expenditure is eligible for amortization but subject to this limit. So the specified expenditure, the total amount cannot exceed this limit. VRS expenditure is allowed as deduction under section 35 DDA, and all the SSEs are covered by this provision. It covers sums which are paid to an employee in connection with his voluntary retirement, and the amortization is 1/5 every year in 5 annual installments from the previous year in which such sum is paid. 36(1) IAX provides for amortization of family planning expenditure, and this applies to a company only. What expenditure is covered? Which is incurred bona fide for promoting family planning but amongst its employees. If the expenditure is revenue in nature, 100% is allowed as deduction. If it is capital in nature, then it is amortized in 5 annual installments, 1/5. What about a non-company SSE? This special provision does not apply. If it is a capital expenditure, one can explore claim of depreciation as per that provision. If it is revenue, then one can explore the provisions of 37(1). We will now look at expenditure for special purposes, and we will take a look at section 35, which provides for deduction on account of expenditure on scientific research. And these are on 2 counts: payments to specified entities and expenditure on in-house research. First, we look at deduction on account of payment to specified entities. 100% deduction is allowed for sum paid to the following entities. First, if the sum is paid either to a research association or university or college or other institution, and these entities should be approved and notified. You can use the mnemonic RICU for the sake of better learning. In such case, 100% of deduction is allowed, and the condition is that the sum should be paid to be used for scientific research or statistical research or research in social science. Second, if the sum is paid to a company which is registered in India, not outside India, having its main object of what? Of scientific research and development, then 100% deduction is allowed if the sum is paid. The condition is that the company should be approved, and the sum should be paid to be used for scientific research. In both these cases, there may be a situation where after the payment has been made of such sum, the approval which has been granted to the entity has been withdrawn. But in that case, the deduction is not affected. It is not denied merely on this ground. 100% deduction is also allowed in respect of sum paid to a university or national laboratory or IIT or an approved person. The mnemonic which you can use if you want is UNIA. The condition is that the sum should be paid with a specific direction that it shall be used for scientific research, but such research should be undertaken under an approved program. It may so be the case that after the payment has been made, the program is withdrawn or the approval granted to the entity is withdrawn. But in such case, the deduction is not denied merely on this ground. That means the deduction is not affected. Now we come to the second category, which is in-house expenditure. It should be on scientific research, but it should be related to the business of the SSE. This is the condition. It can be after commencement of business or before commencement of business. If such expenditure is after commencement of business, it can be either capital in nature or revenue in nature. If it is revenue in nature, 100% deduction is allowed. If it is capital in nature, then also 100% deduction is allowed. But deduction is not allowed in respect of acquisition of land. It is not allowed in respect of land. What about expenditure which is incurred before commencement of business? That is also allowable as deduction, but there is a time limit. The time limit is expenditure should have been incurred within 3 years immediately preceding the commencement of business. It doesn't refer to immediately preceding the previous year of commencement, but the date of commencement of business. So we pick up this period and we figure out the pre-commencement expenditure. In which year is this expenditure allowed? It is allowed in the previous year in which the business is commenced. And this also can be either of capital nature or revenue nature. If it is capital in nature, then 100% deduction is to be allowed, but not on acquisition of land. If it is revenue in nature, then deduction is allowed only on 2 counts. One, payment of any salary. Salary would have been paid to employees engaged in scientific research, or the materials would have been purchased for used in scientific research. Only these 2 categories of expenditure is allowed, provided the expenditure is certified by the prescribed authority. In such case, deduction is 100%. If the expenditure is not certified, or if it is the case of any other expenditure, no deduction is allowable. No deduction is supposed to be allowed. We need to note that salary, which is referred here, it does not include perquisites. Now, if an expenditure is allowed deduction under 35, depreciation is not allowed, whether normal depreciation or additional depreciation. So if 35 is claimed and allowed, depreciation cannot be allowed. Certain tax implications arise when the asset which is used for scientific research is sold. And there are 2 possible situations. In the first situation, the scientific research asset is sold without having been used for any other purpose. Scientific research asset is acquired, deduction under 35 is claimed, and it is straight away sold without being used for any other purpose in the business. In that case, deemed profits arise under section 41(3), which is lower of A or B. A is sale proceeds, or B, deduction made under section 35, which would have been to the extent of 100%. Are these deemed profits taxable even if the business is not in existence in the year of sale? Yes, it doesn't matter. The deemed profits are taxable in the year of sale even if the business is not in existence in that year. Further, capital gains also arise, which is computed in the manner in which capital gains are computed. Second situation is where the scientific research is acquired, a deduction is claimed under section 35, and it is then being used in the business, and after that it is sold, right? So it is used, it is brought into use in the other areas of business, and after that it is sold. So when the asset is used in the business, after it ceases to be used for scientific research, the assessee would like to claim depreciation. Depreciation would become admissible, and therefore the asset would be added to the relevant block of assets. But at which actual cost? What will be the actual cost at which the asset would be added? So actual cost will be nil or 0. Why? Actual cost of asset minus 100% deduction earlier allowed under section 35. So effectively, depreciation will not be allowed in effect on account of this asset, but it will be added to the relevant block of assets. Now, when this asset is sold, since it is a part of block of assets, capital gain will be computed under section 50, which we will talk about in the topic on capital gain, since the asset is part of block of assets. Coming now to the deduction on account of interest, and this is provided by section 36(1)(3)(i). What is covered is interest which is paid in respect of capital borrowed. If the capital is borrowed for personal purposes, deduction is not allowed. But where the capital is borrowed for the purposes of business or profession, deduction is allowed. It depends then on whether the loan or borrowing is from a bank, public financial institution, state financial corporation, state industrial investment corporation, or an NBFC, or whether the loan or borrowing is from any other person. If the loan or borrowing is from these specified entities, then deduction is allowed under this section, but it is subject to compliance of section 43B. But if the loan or borrowing is from any other person, the deduction is allowed under this provision, and section 43B compliance is not necessary. There is another angle to it, And this is what we have already discussed when seeing the computation of actual cost for the purposes of depreciation. So this covers a case where interest is paid in respect of capital borrowed for what? For acquisition of an asset. In that case, we need to bifurcate the interest before and after a particular date. And that date is the date on which the asset is first put to use. Till that date, whatever interest is computed, it is added to the actual cost, and then depreciation becomes allowable on that actual cost. After this date, whatever interest may be, it is not added to the actual cost, rather deduction is allowed under this provision 3613I as per these provisions that we have discussed. What about interest which is payable but not on capital borrowed? For example, interest may be payable on delayed payment to vendor for purchase of goods. In such case also deduction is allowed not under this provision but under the general deduction provision of 37(1). What about expenses to arrange the loan, brokerage commission, etc.? It is deductible not under this provision but under the general deduction provision of 37(1). What if TDS is required to be deducted as source on payment of interest? Then the provision of section 40AI and 40AIA become applicable, and disallowance can be made if these provisions are not complied with. We will look at these provisions in some time. Now we move to the deductions governing employee welfare. What are the deductions available in respect of contribution to employee welfare funds? It depends on the category of the fund and whether the sum which is paid by the assessee is the employer's contribution, that means own contribution, or whether it is sum which is received by the assessee from the employees as their contribution. That means employees' contribution which is received by the assessee to be deposited by the assessee on their behalf in the fund. Number 1, where the fund is a recognized provident fund or approved superannuation fund. Employer's contribution is deductible subject to compliance with 43B. In this case, what about employee's contribution which is received by the assessee? It is first included as income of the assessee, and thereafter deduction is allowed to the assessee provided the sum is credited to the employee's account in the fund on or before which date? Not the due date of furnishing return of income, but on or before the due date as per the rules of the fund. If this condition is not satisfied while it is included in the income of the assessee, no deduction is allowed. Second, approved gratuity fund. Employer's contribution is deductible subject to 43B compliance, but provision for gratuity is not deductible. Now there are certain provisions which apply in this respect, and on a consideration of all the provisions, the net effect is this: that deduction is allowed in respect of approved gratuity fund in respect of this particular area for either of the following: A, B, C or D. Deduction is allowed either for, when we talk about contribution to approved gratuity fund, it can be payment of contribution to approved gratuity fund or provision made for such payment, that is for contribution to approved gratuity fund. Both payment as well as provision for payment is allowable as deduction. When we talk about the payment of gratuity, it can be either provision which is made for payment of gratuity but only for gratuity that has become payable during the previous year, or it can be payment of gratuity during the previous year. In A, B or C or D, deduction is allowable, but deduction is allowable for either of the following. That means one of these. So for example, if a provision has been made for contribution to approved gratuity fund, the deduction is allowed, but then the deduction is not subsequently allowed once again when the payment of contribution is made to the approved gratuity fund, or out of that fund payment of gratuity is made to the employee. So deduction is allowed for either of A or B or C or D. Health insurance premium is allowable as deduction which is paid by the employer for his employees, but the condition is that payment should not be in cash. If it is in cash, no deduction is supposed to be allowed. Bonus and commission paid to an employee is also allowed as deduction, but there is a condition that it should not have been payable as profits or dividend if it had not been paid as bonus or commission. That means bonus or commission should not be paid in the guise of profits or dividend. This deduction is subject to compliance with section 43B. We now look at deductions provided on account of taxes. As far as securities transaction tax STT or commodities transaction tax CTT is concerned, which is paid by the SSE, the deduction in computing PGBP income is allowed only if the security or commodity is held as stock in trade. Because if it is held as capital asset, capital gain will arise and it will not be covered under the head PGBP. What about income tax? Section 48(2)(i) is the relevant section. Income tax is not allowed as deduction, it is disallowed. This not only includes income tax, but also surcharge, cess, interest, fine, penalty, fees under the Act. What about refund of income tax? Since income tax is disallowed, refund of income tax is not taxable. But as far as interest on delayed refund of income tax is concerned, it is taxable. Interest on refund is taxable, but not under this head, under the head IFOS. What about other taxes? For example, indirect tax or municipal tax, professional tax, etc. These are allowed as deduction under section 37(1), but that is subject to compliance with 43B. What about a penalty which has been paid? Right? So penalty, say under these other taxes, can be of two categories. Penalty can either be for breach of law. In such case, it will be penal in nature. It will not be allowed. There can be another kind of penalty which is not penal in nature, but which is compensatory in nature, to compensate for the loss of revenue to the government. In such case, it is allowed as a deduction. Now, section 40AB deals with tax on non-monetary perquisites. While discussing the topic on salary, we noted that if the employer pays tax on behalf of the employee on non-monetary perquisite, although it is generally considered as perquisite because it is the obligation of employee which is met by the employer, but it is specifically exempt in the hands of the employee under section 1010cc. Consequently, such tax which is paid by the employer is disallowed in the hands of the employer under section 40AV. Now we look at certain special deductions. Bad debts are covered by section 36(1)(7). And the deduction is allowed in respect of any bad debt which is written off as irrecoverable in the books of accounts of the SSE for the previous year. If it is written off as irrecoverable in the books, then a deduction is allowed. If not, then deduction is not allowed. But if it is so, then a further condition needs to be satisfied. It needs to be checked whether such debt has been taken into account in computing the income of the SSE or not. If it was taken into account in computing the income of the SSE, for example, sales, well, sales occurred, the SSE would have taken into account the sales in computing his income. And then the amount became bad and it is written off as irrecoverable. In such case, the amount of such debt is allowed as a deduction. But where such debt has not been taken into account in computing the income, for example, in the case of loan, then it is not allowed as a deduction. Then it is not allowed as a deduction. But there is only one exception. That exception is the business of banking or money lending. In the case of banking or money lending, the loan which is given would not be taken into account in computing the income of the SSE, but it represents money lent in the ordinary course of the business of banking or money lending. In that case, there is an exception. In such case, the bad debt will be allowed as deduction under this provision. What about provision for bad and doubtful debts made in the accounts? It is not allowed as a deduction. Provision is not allowed as a deduction. Now, after the deduction has been allowed, there may be a subsequent recovery or ultimate recovery. And then tax implications arise. And there are two steps. In step 1, we calculate is what we call is the difference. Difference is what? Amount of debt minus the amount that was deducted under this provision. In step 2, there are two situations. Number 1, if the amount ultimately recovered is less than this difference, then there is a deficiency. That deficiency is deductible in the previous year in which the ultimate recovery is made. But if the amount subsequently recovered is more than the difference, then there is an excess, and that excess is taxable as deemed business income of the previous year in which it is recovered. What if the business or profession for which deduction was allowed earlier is not in existence in the year of recovery, even then the excess is taxable. Even then the excess is taxable. We now look at deduction on account of remuneration and interest to partner of a firm or LLP, and the relevant section is section 40B. So a firm is allowed deduction on account of remuneration to working partner, not to a non-working partner, and is also allowed deduction of interest whether to working partner or non-working partner. And there is a limit up to which the deduction is allowed. So there is an upper cap. As far as the remuneration is concerned, the upper cap is determined based on the quantum of book profit. What is the formula? On the first 3 lakh of book profit, or in the case of loss, the deduction is allowed to the extent of higher of 1.5 lakh or 90% of book profit, and on the balance of book profit at the rate of 60% of that balance. So basis this formula, we compute the amount that becomes the upper limit for allowing deduction of remuneration to working partner in the hands of the firm. As far as deduction of interest goes, deduction is allowed only up to 12% simple interest per annum. Beyond 12%, interest is disallowed. When we talk about remuneration, it means salary, bonus, commission, or remuneration by whatever name called. Book profit is important. It's an important consideration. What does this mean? It means income under the head PGBP, not under any other head. Income under the head PGBP, but before deducting remuneration to partners, right? So if the remuneration has been deducted, we need to add it back. Remuneration to non-working partners is not allowed as deduction, but interest to working as well as non-working partner is allowed as deduction. What about taxation in the hands of the partner? So if the amount is allowed as a deduction in the hands of the firm, it is taxable in the hands of the partner. If the amount is not allowed in the hands of the firm, it is not taxable in the hands of the partner. So interest, salary, bonus, commission, or remuneration, if it is deductible in the hands of the firm, it is taxable in the hands of the partner, but not under the head salaries, under the head PGBP. What about share of the partner in the total income of the firm? It is not covered under section 40B. We have noted earlier in the topic on exempt income that it is exempt in the hands of the partner under section 10(2)(a). There may be a situation where the inventory is converted by the SSE into his capital asset. Relevant section is 28 VIA. When the inventory is converted into a capital asset, business income arises at the time of conversion, and the business income is equal to the fair market value on the date of conversion. Now after the conversion, the capital asset may be used for business or profession. In such case, for the purpose of depreciation, we will need to figure out the actual cost. Actual cost will be the fair market value which is taken here, right? Now, this inventory which is converted into the capital asset, if it is subsequently transferred, that means, for example, if it is sold, then capital gains arise. We will look at this when we discuss topic on capital gain. Now, so far we were looking at the various specific deductions under different provisions. Now, section 37(1) provides for a general deduction. That means whatever we have not covered in the provisions and whatever is not described in those provisions can fall under this provision. It can be claimed as a general deduction. Any expenditure is deductible under section 37(1) provided all the following 5 conditions are satisfied. Number 1, it is not of a nature described in sections 30 to 36. And if that be the case, then the provisions of those sections apply, and allowance or disallowance is made as per the provisions of those sections. Second, it is not capital expenditure. It should be revenue. Third, it is not a personal expense of the SSE. Fourth, it should be laid out or expended wholly and exclusively for the purposes of business or profession. And lastly, it should not be incurred for any purpose which is an offense or which is prohibited by law. And this includes A, B, and C. It includes expenditure which is an offense or prohibited by law, not only an Indian law but also a foreign law. Okay. It also includes expenditure to provide any benefit or perquisite to a person. Right. So the SSE incurs expenditure to provide a benefit or perquisite to a person But where the person is accepting such benefit or perquisite, that acceptance is in violation of any law, rule, regulation, or guideline. And thirdly, to compound an offense under any law, whether it be Indian law or foreign law, compounding fees. So A, B, C are also not allowed as a deduction. They are included in the condition 5. Certain instances of expenditure deductible under section 37(1), all the above conditions are fulfilled in these cases. Scheme and insurance premium, the litigation expenses to defend business, legal and compliance expenses like filing of returns, audit, etc. Penalty which is not penal in nature, which is compensatory in nature. Damages for failing to fulfill terms of a contract. Expenditure on raising loan or borrowing like brokerage, bank charges, drafting or loan agreement, etc. Salary to employees, professional tax. Interest, not being interest on capital borrowed because that is covered under section 36(1)(3)(I). So interest like what? Interest on delayed payment of purchase price, etc., which is not in respect of capital borrowed. Advertisement expenditure, customary expenses, say on Diwali, Muhurat, New Year. Training expenses to gain skills for use in business or profession. We now look at instances of expenditure which are not deductible under 37(1) because one or more of the above said 5 conditions are not satisfied. Reserve created against contingent liability because it is not an expenditure which is incurred. Protection money, extortion, hafta, bribes, all these are offences. Freebies, gifts, travel, cash, etc., which is provided to medical practitioners by the pharma industries. Why? Because acceptance of such benefit is in violation of the Medical Council of India guidelines. Penalty and damages paid for infringement of law, it is an offence. CSR expenditure under the Companies Act is specifically disallowed by virtue of explanation 2 of section 37(1). If there is expenditure on advertisement in a publication of a political party, it can be a souvenir or brochure or tract, pamphlet or the like, then that is specifically disallowed by section 37(2)(b). Appropriation of profits like dividend, transfer to reserve, etc. is not allowed because it is not an expenditure to earn income. Expenditure which is disallowed under any specific provision cannot be allowed under section 37(1). We will now see expenses which are not deductible in certain circumstances, and first we will take a look at section 40(a)(ia), which deals with payments on which tax is not deducted or paid, basically where TDS provisions are not complied with. There are 3 sections basically, 40(a)(I), 40(a)(ia) and 40(a)(3)(I), but 40(a)(ia) is more relevant from an exam perspective, so we will only take a look at this provision. What is the payment that is covered by this provision, by this disallowance? It covers any sum which is payable to a resident during the previous year. When is the payment disallowed under 40(a)(ia)? The payment is disallowed in either of these 2 situations. Where tax has not been deducted in the previous year. So TDS was required to be deducted. Okay, so this provision doesn't apply where TDS is not required to be deducted in the first place. Where TDS is required to be deducted and where sum is payable to a resident, then this provision applies. In such case, situation 1, where tax has not been deducted in the previous year, disallowance is made. Or the second situation is that where though tax has been deducted in the previous year, but it has not been paid to the account of the government. And there is a timeline. By when should it be paid? Right? It should be paid on or before the due date to furnish return under section 139(1) of such previous year. So, if though the tax has been deducted in the previous year, but it has not been paid on or before such due date to furnish return of income for such previous year, then disallowance is made. In both these cases, what is the quantum of disallowance? 30% of such sum is disallowed. That means 70% is allowed as deduction, 30% is disallowed. What is the effect of this? No disallowance is made in the previous year in which expenditure is incurred, in either of cases 1 or 2. If tax has been deducted and paid in that previous year, so the full compliance is made, no issue. Or tax has been deducted in the previous year, but it is paid when? By the due date to furnish return of that previous year. In that case also there is sufficient compliance and no disallowance is made. Disallowance is not permanent. Disallowance can be rolled back. That means 30% of the sum which has been disallowed can be subsequently allowed as deduction where either of these 2 situations are fulfilled. 1. So we noted above in 1 that disallowance is made when tax has not been deducted in the previous year. Disallowance can be rolled back where tax has been deducted in any subsequent previous year. Right? So above we also noted that disallowance is made where though tax is deducted in the previous year but it has not been paid even till the due date to furnish return of income of such previous year. That means disallowance can be rolled back where though tax had been deducted in the relevant previous year but it is paid after the due date to furnish return of income for that previous year. Okay. In either of these cases, the deduction is allowed. That means disallowance is rolled back in the previous year in which such tax is paid. Now, as we noted above in 1, that disallowance is made where tax has not been deducted in the relevant previous year by the payer. Even in such case, deduction can still be claimed by the payer, provided the payee fulfills these 3 conditions. 1. The payee has furnished his return under section 139. The payee has taken into account such sum for computing income in such return. And 3. The payee has paid the tax due on the income declared by him in such return. Further, the payer furnishes a certificate to this effect from an accountant in the prescribed form. If these conditions are satisfied, then even if the payer has not deducted the tax, then the payer is deemed to have deducted and paid the tax on such sum when on the date of furnishing of return by the payee. And accordingly, the disallowance of 30% that was made earlier will now be rolled back even if the payer had not deducted tax at source. Thus, what is the effect? While the sum is disallowed in the year of incurring expenditure, because tax had not been deducted in the previous year, 30% was disallowed, but then it is now allowed in the year of furnishing of return by the payer if the above conditions are satisfied. We now move to the next disallowance in respect of related party transactions, section 40A2. What are the conditions for disallowance? 1. The assessee has incurred expenditure in respect of which payment is made to a related party, and the AO is of the opinion that such expenditure is excessive or unreasonable. Then so much of the expenditure as is considered to be excessive or unreasonable by the AO is disallowed. Now the question is, who is a related party? So related party is any relative of the assessee. Assessee relative is the relative party. This is the related party. Second, any person who carries on a business or profession. Say this is the person carrying on business or profession where the assessee has a substantial interest in the business or profession of that person. So assessee has substantial interest, or any relative of such assessee has a substantial interest, or any relative has a substantial interest. In that case also, this particular person who is carrying on a business or profession will be considered as a related party in the context of the assessee. So any payment made to related party will fall under section 40A2. Now who is a relative? Relative means spouse, brother, sister, or any lineal ascendant or descendant. You can use the acronym SBS LAD for quick learning. And what is the meaning of substantial interest? For substantial interest, the person should be the beneficial owner of 20% or more equity shares if it is a case of a company, or should be beneficially entitled to 20% or more of business profits in the case of non-company. At what time? At any time during the previous year. Section 40A3 makes disallowance in respect of payment by non-specified mode greater than 10,000, and note that we have already made reference to it in the context of actual cost and section 35 AD. Under section 40A3, what is the disallowance? It's of any expenditure in respect of which a payment is made to a person in a day which is otherwise than by a specified mode exceeding rupees 10,000. In case of multiple payments, we need to consider the aggregate. In case of transporters, where say the payment is made for plying, hiring or leasing of goods carriages, this 10,000 limit is raised to rupees 35,000. The specified modes are the same as that we have discussed earlier in the context of actual cost. So since similar provision exists for actual cost and 35 AD, section 40A3 provisions does not apply in those cases. There may be a situation where the deduction, where the expenditure is allowed as a deduction in full in a previous year on due basis. Payment has not been made, but on due basis. Now payment is made in a subsequent previous year, but it is made in violation of section 40A3. It is made in a non-compliant manner. Okay, what will happen? Disallowance cannot be made because expenditure has already been allowed in full. So the other way around is that to make this payment taxable as deemed business income of such subsequent previous year. So the effect becomes the same. So while the expenditure was allowed in the earlier previous year, in the previous year in which non-compliant payment is made, deemed business income becomes taxable to the extent of that payment. There is a list in Rule 6DD which prescribes cases where disallowance is not applicable even if the payment is non-compliant. Two cases that we need to note from an exam point of view. Disallowance is not made where payment is made to Reserve Bank or any bank or LIC or to the government. Disallowance is not made where payment is made by way of a book adjustment. That means by way of adjustment against the amount of any liability incurred by the payee for any goods supplied or services rendered by the assessee to such payee. So if A is supposed to pay to B and B is then supposed to pay to A, so the accounts are settled or squared off by way of a book adjustments, then this squaring off is not covered by the disallowance provision. Section 43B covers a case where the deduction is supposed to be allowed in respect of certain sums only on actual payment. If 43B is not complied, disallowance is made and the payment is not allowed as a deduction. There are 7 sums which are covered by this provision. 1. Tax, duty, cess or fees by whatever name called under any law, for example GST. 2. Employer's contribution, not employee's contribution, employer's contribution to Provident Fund, Superannuation Fund, Gratuity Fund or any other employee welfare fund. 3. Bonus or commission to an employee, which we have discussed some time back under section 36(1)(2)(i). 4. Interest, we discussed this some time back under section 36(1)(3)(i). What is covered here? Interest on loan or borrowing from PFI or SFC or SIIC or deposit taking NBFC or systemically important non-deposit taking NBFC. 5th, interest on loan or advances from a scheduled bank or some other categories of banks. 6th, leave salary, that is sum payable to an employee by the employer in lieu of the leave standing to the credit of the employee. And lastly, payment made to the Indian Railways for use of railway assets. In respect of these sums, deduction is only allowed on actual payment, and there are 3 situations which are possible. Situation A, there is no issue. That the sum is actually paid in the previous year in which liability is incurred. So the liability is incurred and the payment is made in the same previous year. There is no issue whatsoever. So deduction is allowed of such sum in the previous year in which liability is incurred. The problem arises in situation B, where the sum is not actually paid within the same previous year. But deduction is still allowed in the same previous year if the sum has been actually paid on or before the due date for furnishing return of income under section 139(1) in respect of such previous year. And the further condition is that the evidence of such payment should be furnished by the assessee along with the return of income. So long as though the sum is not actually paid in the year in which liability is incurred, but it is paid till the due date of furnishing ROI, even then the effect remains the same, that deduction is allowed in the relevant previous year in which the sum became due. But where the sum is not paid even till the due date of furnishing return of income, deduction is not allowed in the relevant previous year. So this will be a case where the sum is actually paid after the due date of furnishing return of income referred in situation B. In that case, when will the deduction be allowed? It will be allowed only in the previous year in which such sum is actually paid, not in the previous year in which the liability was incurred. In certain cases, interest may be converted into a loan. So interest is payable. As we saw, it is one of the sums which is covered by section 43B. Interest which is payable, instead of actual payment of interest, it may be converted into another loan or borrowing or debenture or any other instrument. So that conversion is not considered as constructive payment, and therefore deduction is not allowed. Deduction of such interest payable is allowed only once such interest is actually paid, not on such conversion. Now we look at certain special provisions. Section 41(1) covers a case of recovery against deduction already allowed. This is a case where there is a loss or expenditure or trading liability in a previous year and the SSE is allowed a deduction or allowance in respect of this in computing the income. But subsequently during a previous year, the SSE has obtained an amount in respect of, say, the loss or the expenditure which was earlier allowed as a deduction, or say the trading liability has been remitted or it has ceased and there is a benefit which has been obtained by the SSE in respect of the trading liability. In that case, since a deduction or allowance was already allowed earlier, then the amount which is obtained or the value of benefit which is obtained by the SSE is taxable as deemed profit in the year of recovery. Even if the business or profession is not in existence in that year, it does not matter, it is not relevant. It is taxable, deemed profits are taxable in the year of recovery. What if it is a case of amalgamation, demerger or succession of the business where the amount of benefit has not been obtained by the original SSE but maybe by the successor? In that case, the successor is taxable under section 41(1). Section 176. There is a business which was running and the business is discontinued and there is a sum which is received after such discontinuance, and such sum had not been taxed while the business was running and the sum has been received after discontinuance. In such case, the sum will be taxable as income of the recipient when in the year of receipt. Section 43CA makes a special provision for determining full value of consideration for transfer of land or building. So it covers a case where there is transfer of what? Of land or building which is not a capital asset. If it is a capital asset, capital gains will arise and the corresponding provision will be section 50C. This is PGBP, 43CA applies, and this will be a case where land or building is a stock in trade. That means this covers a case of a person engaged in real estate business. In that case, we need to figure out what is the actual consideration and what is the stamp duty value. We need to compare both. If SDV is more than 110% of the consideration, then full value of consideration for on such transfer is not taken to be the actual consideration but rather the SDV, and business income is computed accordingly. But if SDV is not greater than 110%, then actual consideration is accepted. Where the SSE claims that the SDV is even more than the FMV and that is unjustified, and the SDV has not been disputed by him in any appeal or forum, authority or court, then the assessing officer or AO may refer the valuation of the property to the valuation officer. In that case, where the valuation by the valuation officer is even more than SDV, then a benefit is given whereby the valuation of the valuation officer is not considered but SDV is taken as the value of consideration. But where the valuation by the valuation officer is not more than SDV, that means it is either SDV or less than SDV, then the valuation ascertained by valuation officer is then taken to be the full value of consideration. So SDV is benchmarked against the actual consideration, and stamp duty value will be on the date of transfer, which is the date of registration of the property. But there may be a date of agreement to sell which may be earlier than the date of registration, and the SDV on the date of agreement and the SDV on the date of registration may not be the same. In that case, the SSE can take the SDV on the date of agreement instead of SDV on the date of registration or transfer, right? But if one condition is satisfied, what is that condition? That the consideration, maybe the whole or a part, should be received by a specified mode on or before the date of agreement. Specified mode is the same that we have looked in the context of disallowance of expenditure more than 10,000 made by non-specified mode. The same specified modes are applicable here as well. There are two important compliance related provisions which we will check. The first is on compulsory maintenance of account and then tax audit. 44AA is the provision covering compulsory maintenance of accounts. The requirement depends on whether the person is carrying on a specified profession or not. What is a specified profession? It covers legal, medical, engineering, architectural, accountancy, technical consultancy, interior decoration, authorized representative, film artist, company secretary, and information technology. If the person is carrying on a specified profession, then we need to determine the total gross receipts in the profession. For what period? All the three immediately preceding previous years. If for all these years the gross receipts is more than 1.5 lakh, then rule 6F applies and the person should keep and maintain books and other documents as prescribed in rule 6F. If this condition is not satisfied, then reasonable books of accounts only need to be maintained. That means those books of accounts and other documents as may enable the AO to compute his total income in accordance with the provisions of the Act, reasonable books of accounts. What if the person is not carrying on a specified profession? That means a person is either carrying on a business or a non-specified profession. In this case, we need to check what? We need to check 1. Income from business or profession, and 2. We need to check total sales, turnover or gross receipts in business or profession. When? For what period? In any one of 3 immediately preceding previous years. So if the income from business or profession, if the income from business or profession is more than 2.5 lakh in any one of these 3 previous years, or if total sales, turnover or gross receipts in business or profession is more than 25 lakh in any one of 3 immediately preceding previous years. If this condition is satisfied, then reasonable books of accounts and documents need to be maintained. If this is not satisfied, then there is no requirement which has been prescribed in respect of maintenance of accounts. Now we need to note that the limit of 2.5 lakh and 25 lakh, they apply to an individual or HUF. For other persons, the corresponding limits are for 2.5 lakh it is 1.2 lakh and for 25 lakh it is 10 lakh. What if the business or profession is newly set up? That means what happens in the first year? In such case, how do we check the 3 immediately preceding previous years? In that case, it should be checked if monetary limits which are given above are likely to exceed during such previous year, that means the current previous year. Now we take a look at the tax audit provisions under section 44AB. This depends on whether the person is carrying on a profession or a business. In case of a profession, we need to check gross receipts. The threshold is 50 lakh. If gross receipts exceeds 50 lakh, then tax audit is required. Otherwise, tax audit is not required for the previous year. Where the person is carrying on a business, then we need to check whether both these conditions are satisfied. And both these conditions are satisfied. The first condition is it refers to the amounts received during the previous year. So we need to figure out all the amounts received during the previous years, and they include amounts received for sales, turnover or gross receipts. We aggregate all of that. Then we figure out amounts which are received during the previous year in cash mode. And the amounts received in cash mode should not be more than 5% of the total amounts received. This is condition number 1. Condition number 2, we do the similar exercise for payments. So we determine the payments made during the previous year. And this includes amounts which are incurred for expenditure. And then we determine payments made in cash mode. So payments made in cash mode during the previous year should not be more than 5% of the total payments made. If both conditions 1 plus 2 are satisfied, then the threshold for tax audit is rupees 10 crore. Else, if both the conditions are not satisfied, then the threshold is rupees 1 crore. And this threshold is to be seen in respect of what? Total sales, turnover or gross receipts in business in the previous year. If this exceeds more than 10 crore, where 10 crore threshold applies, then tax audit is required, otherwise it is not required. Where it exceeds rupees 1 crore in the previous year, where threshold of 1 crore applies, then tax audit is required, otherwise it is not required. Now, what is the meaning of cash mode? So cash mode is what? It is cash, and it includes check which is not account payee and bank draft which is not account payee. These three modes of payments are considered as payments or receipts in cash mode. Once tax audit becomes applicable, then two things need to be done in terms of compliance. One, the person should get his accounts of the previous year audited by an accountant before the specified date. And two, furnish a tax audit report in the prescribed form by the specified date. So what is the specified date? It is the date which is 1 month prior to what? To the due date for furnishing ROI under section 139(1). For example, if ROI due date is 31st of October, then the due date to furnish tax audit report will be 30th of September. We will now look at the presumptive income provisions for small enterprises. And there are three schemes. 44AD applies to a business, 44AD applies to a profession, 44AE applies to a goods carriage business specifically. First, we look at the provisions of 44AD. And this applies to an individual, HUF or a partnership firm who is a resident, but LLP or any other person is not covered. The SSE should be engaged in any business, but not under section 44AE because it's a separate scheme. And the total turnover or gross receipts in the previous year should not be more than 2 crore. Further, the SSE should not claim deduction under section 10AA for special economic zones, newly established units, or under chapter VIAC, that means under sections 80HS to 80 RRB, right? If presumptive income is availed 44AD, then these deductions cannot be claimed. If presumptive income provisions are not availed, then these deductions can be claimed. The person should not be carrying on a specified profession under section 44AA, or should be earning commission or brokerage income, or should be carrying on agency business. Section 44AD does not apply to these persons. If the aforesaid eligibility criteria is fulfilled, then we compute deemed profits and gains under section 44AD, and it is A plus B. For this, we determine the turnover or gross receipts in the previous year on account of such business, and we bifurcate into two parts. One, that turnover or gross receipts which is received by specified modes. Specified modes are the same as we had been discussing in this video. So that which is received by a specified mode when? Either during the same previous year or before the due date for furnishing ROI under section 139(1) of that previous year. That turnover or gross receipts, we compute 6% of that, and that is A. For any other turnover or gross receipts, that is the second component. We compute a higher presumptive rate of 8% on that. That becomes B. A plus B is equal to deemed profits and gains of such business taxable under the head PGBP under section 44AD. Since the income is determined at a predetermined rate, deductions under sections 30 to 38, all the specific deductions are deemed to have been already given full effect to. Therefore, no further deduction is specifically allowed. The SSE can claim a sum which is higher than the presumptive income. The SSE can claim a higher sum to have been earned by him. What about books of accounts and tax audit? If the SSE declares profits and gains under 44AD, he is not required to comply with maintenance of books of accounts and documents under section 44AA or tax audit under section 44AB. Can the SSE claim a lower income than that computed under 44AD? Yes. But there is a restriction. If the SSE declares profits for any previous year under 44AD, then he should continue to do so for next 5 previous years as well. So 1 plus 5. So that means there is a lock-in of 6 years, 6 previous years. There is a lock-in under section 44AD of 6 previous years. What if there is a default? That means If he declares profits for any of such 5 previous years, that means within the lock-in period, which is otherwise then under 44AD, that means if he opts out in between, then what will happen? He shall not be eligible to claim 44AD benefit for the next 5 previous years. That means the previous year in which he opts out, that is the first previous year, he doesn't claim 44AD. He will also be moved out forcibly out of 44AD for the next 5 previous years. So for 6 previous years, he will be out of 44AD. And for these subsequent 5 years, for which he is moved out of 44AD, two implications will arise. And this depends on the level of total income. If the total income is more than the basic exemption limit, then the two implications that will arise is he will need to comply with 44AA and 44AB. But if total income is not more than basic exemption limit, then these requirements will not be there. So this is about 44AD. Now we come to 44ADA, which deals with a case of profession. And this applies to whom? This applies to an individual or a partnership firm who is a resident. So it doesn't apply to an LLP, an HUF, or any other person. The condition is that the assessee should be engaged in a profession, but not all, in a specified profession which we have discussed in 44AA. And the total gross receipts in the previous year should not be more than 50 lakh. If this is satisfied, then 44ADA can be availed, and deemed profits and gains of such profession will be equal to 50% of the total gross receipts of in the previous year on account of such profession. Like 44AD, no specific deduction will be allowed. Like 44AD, a higher sum than 44ADA can be claimed to have been earned. Like 44AD, 44AA and 44AB will not apply. Can the assessee claim a lower income? Now there is a difference. As against 44AD, assessee can claim lower profits and gains in any previous year, so the lock-in concept of 6 years doesn't apply here. But the same implications arise which were there for 44AD in the year when the assessee wants to move out. The same implications as we had discussed for 44AD, they apply. Now we come to 44AE. And this applies to all the persons. And the condition is that the assessee should be engaged in the business of what? Plying, hiring or leasing of goods carriages. And should not own, so ownership is important, should not own more than 10 goods carriages when? At any time during the previous year. If this condition is fulfilled, then deemed profits and gains can be computed under 44AE. And how do we calculate? This is the formula. And this calculation is to be done for each goods carriage which is owned by the assessee in the previous year. The formula depends on whether the goods carriage is a heavy goods vehicle or other vehicle. What is a heavy goods vehicle? Heavy goods vehicle means any goods carriage whose gross vehicle weight is greater than 12,000 kg, which means greater than 12 ton. So for a heavy goods vehicle, the formula is rupees 1,000 into gross vehicle weight or unladen weight, as the case may be, in ton, further multiplied by months or part of a month during which the vehicle is owned by the assessee in the previous year. So put to use condition is not relevant. The calculation is done based on the months of ownership, even for a part of a month. For vehicle which is not, for a goods carriage which is not a heavy goods vehicle, the formula is what? 7,500 multiplied by months or part of month of ownership by the assessee during the previous year. Similar to 44AD and 44ADA, no specific deductions are supposed to be allowed, but there is an exception. Where the assessee is the firm, then salary and interest to partners is also deductible from 44AE computed income, which is subject to limit under section 40B that we have discussed some time back. This exception is not available under 44AD and 44ADA. A higher income can be claimed to have been earned for each vehicle. Like 44AD and 44ADA, 44AA, tax audit, 44AB and books of accounts 44AA are not applicable. What about claim of lower income? An assessee can claim lower profits and gains than 44AE in any previous year, but these two things need to be complied with, which is 44AA and 44AB. So this brings us to the end of the topic on PGBP.